welcome to your hump day edition of the TraderMerlin Show. It is Wednesday. Happy trading, everybody. Good to see you all with us. I see we had Les, of course, starting things off. Simon, Eric, good to see you, Eric, as well. Kenny, Tom, and yes, Tom, I got your email. I'm not 100% sure I'm even going to be in center on Saturday. I know this is supposed to be broadcast at a whole bunch of different centers, so I'll check with them. If I'm in center, yeah, I'll gladly go out with you and your wife for maybe it's actually breakfast at that point, right? I think we're supposed to end at 9:30. I'll probably get out of there like 10 o'clock. But if I'm in center, certainly. If not, we'll maybe catch up some other time. But we'll see how that event goes this Saturday. Siraj, good to have you with us as well. Jerry, Ken, we got Dana, and you're awesome too, Dana. I caught your message the other day. You're awesome. Lori, Walter as well, and everybody else. Good to have you all with us. Susan, John. Terry, today's discussion actually comes from a gentleman who is in Singapore right now, and he's one of the regulars who watches the show. May not be watching live, but he always comments on the YouTube stream, so I appreciate everything that Landis does for me. So Landis, thank you so much. Here is the question that he poses. He says, I keep hearing that it doesn't matter when the crash is coming, just be prepared for the crash. But how exactly should a trader plan for this, or what should they do for a crash? You know, keeping 50% maybe in cash, or having X percent in portfolio in gold, or maybe Bitcoin, putting X percentage in real estate. What exactly do you do? And so I thought, you know what, that's a great topic. Let's keep it. And I don't have any flashy backgrounds either on this screen here. It's just, hey, prepare for a market crash. Like, what should we be doing? How can we prepare? So one of the things that's bugged me about doing that, not only teaching classes physically for Online Trading Academy, but also doing power trading radio for a decade and doing this show for a year and a half now, is a lot of times people will send in or ask me about a specific stock. Hey, can you analyze this one? What do you think about Microsoft? Who should I go long on the euro? Or hey, what about the Aussie dollar? That's all great, because I know a lot of people are looking for maybe a different perspective, maybe a different set of eyeballs or opinions about a trade. But almost, I would say probably like 5% of the time, somebody says it the right way, which would be, hey, I'm thinking about going short on the Aussie dollar. It's been in a downtrend for the past couple weeks. I'm thinking about going short at this level. Here's my stop loss. Here's my target 1. Here's my target 2. That to me is like, okay, you know what you're supposed to be doing. You have to have that plan in place. And for me, the big problem with these crashes or corrections, whatever percentage you want to call a market coming off the highs, the big problem here is that almost everybody just says, I'm buying it here and I'm hoping I make money. I think I'm going to buy it at 10, and it's going to go to 300, right? That's the normal mindset. But we always have to have that contingency plan that says, what do I do if this doesn't work in my favor? And right now, we might be at that moment in time that the market's turning. Could today's action and yesterday's couple of 2 down days be the beginning of a 50% slide in the market? Yeah, it absolutely could. Of course, it could just be a small little pullback, and we get a huge market rally up another 50%, right? The markets are unpredictable. I like to say that I'm a probability guy, meaning I'm looking at what are the odds, what's the highest probability of a trade working in my favor, whether that's long, short, or even going sideways. Now, right now, the probability is higher that the market is going to go up. But as I tweeted out today, every day that this market grinds itself to another all-time high, seemingly month after month after month, the odds get higher that you're going to have not only a correction, which I would say is a 10% drop or up to 10% drop. Not only should you get a correction, you should probably get a bear market pullback, right, which would be 20%, and you possibly could get much more than that. It's just a question of when. Now, of course, I know Brendan's here, and I think we'd all agree that the Fed is going to do everything in their power to not let that happen. They'll prop up this market in any way that they possibly can. And from my perspective, they'll do so without really thinking about ramifications down the road. If you look at the increase in M1 and M3 money supply over the past year and a half, it is jaw-dropping. I've never seen a curve like that before in anything in financial markets. People think the price of Bitcoin charts is parabolic and ridiculous. Look at the amount of dollars that have been increased, right? We're not thinking about down the road. We're thinking about saving the markets right now. To me, that's a bit short-sighted by the Fed. All right, that said, how do we prepare for this? Okay, so I didn't have time to prepare PowerPoints and have all the visual, nice graphics, so I real quickly wrote down notes on what I would do in this situation. For every long position that you have, so if you're a long-term investor, got 401ks, IRAs. If you're a day trader, who really cares, right? There's no really preparing for a bear market crash. You're just riding whatever wave comes your way on the time frame that you're looking at. But for bigger picture, there needs to be a number in your account that you say, I'm getting out. I'm out at this specific point. So let's say, for example, we'll look at the S&P, which today was down about 1.26%. You know, these last 2 days, while it does look like a nice sell-off, it's really no big deal, right? And again, I had about 3 emails from people kind of panicking a little bit, saying how worried they were that this is the beginning. Well, look, you've said that probably about once a month, right? You see, back here at the middle of July, we fell pretty significantly, right? That was a nice sharp drop. Well, we kept on making new highs. So if history and probability is any indicator, we're going higher, folks. It just seems that way. Now, could we do something like this? And let's say I was long, and I'm just going to use this SPY as an example. I'm going to put that line right across those most recent lows. And I think we could all agree that as far as a challenge point, meaning an area where S&P has had difficulty going below for the last month, it's right there. For those podcasters, we're looking at 4,364 on the S&P. Well, we are screaming towards that today. Who knows? We might actually breach that here over the next couple days. I don't know. But logically, that's a good point for it to bounce. Now, if you were to get out of your long trades at 43.63, and these are trades that you've been holding for a while, you may have some pretty nice gains, right? The key here is locking in those gains. And I don't know whether this is just a small pullback and then it just continues to all-time highs, or if this is the beginning of the end. You know, I'm not trying to be a gloom and doom guy, but you know, you always can look at those two extremes. Now, that line, if we were to look at it, a pullback off the all-time high on the S&P 500 and bring us down to that 43.64 mark, that's only a 2.5% slide. Honestly, that's nothing. That's a drop in the bucket. So, you know, that might be too tight to put your stop losses on. What if we went to something like 5%? All right, 5% would take you all the way down to roughly 42.50, which I think would be another logical stopping point for this one. And I'll put the line right there at 42.50. So you can have that one as a reference point. And it's right, close enough. There you go. And then if we really want to look at the big numbers, we can go to 10%. And so let me drop this down here. 10% gets me to roughly, oh, that's a beauty. Oh, that's a beauty there, eh? That brings you down to about 4,030 on the S&P. So here you have your 2.5% slides, 5% slides, and 10% slides. Now, I'm sure most of you probably don't want to suffer a 10% slide. Isn't that interesting how when I look at it from this angle here, it looks like that's a massive sell-off? But if we zoom out and show you just the run that started just from 2020, those pullbacks look almost insignificant. To really drive you crazy, I'll just put on a weekly here, and we'll go since those March lows. There's your March 2009 lows, and you can see that those little pullbacks would be almost insignificant on the bigger picture. So I'm going to go back to the daily here, and we'll start the analysis from this perspective. So for me, I think everyone needs to have that. What's that line in the sand for you? Is it 2.5%? Is it 5%? What is it where you finally say, you know what? I'm not saying that you're freaking out and going bearish, meaning you're going to start shorting everything under the sun. All I'm saying is at that point, you should probably say, I'm going to be a little bit protective here. I'm taking my money off the table. I'm going to lock in some profits because it might go down even further. I mean, even the sell-off that we had that started back in mid-July, you know, it wasn't 10%. It was the tune of 3.7%. All right. Before that, the biggest sell-off we had was back here in May, which was a sell-off of about 4.9%. So we really haven't had a monstrous pullback in these equity markets since the COVID crash back in February. So, you know, I don't know if I think this might be too tight if you look at that 43.64 mark, but that could be a point for you. What I'm trying to get at here is how do you prepare? You have to have numbers in place. And Naum says 10%. Awesome. All right. Oh, yeah. You think so, eh, Chris? What that was, oh, God, what was the name of that stupid movie? Think so, eh? The two beer drinking guys. I remember that one. Yes, Patrick, we're going to get there. I'm going to get to the options. Basically, I'm looking at step number 1 of everyone's preparation needs to be, what is your number? I don't care what position it is. Make an Excel spreadsheet. Say, here's my positions I'm long on, and just put, here's your stops. And if you can go out to a lot of these platforms. You can double click on these lines. This doesn't do it here, but you can set alerts inside of TradingView or TradeStation, most platforms will have you set alerts. And when you do that, so I can go right here, click on the little alert button, and I can have it send me an email. You might even be able to do a text message. Yeah, you can have it send you a text message. Whatever you want, you can have it alert you if it hits those levels. So you don't need to worry about it anymore. There it is, Strange Brew. Yeah, that's the one. Yeah, that was good. Wait, north, eh? So that makes it step number one easy, and there's two reasons for it. Number one is this is the point you say, I'm just going to lock in some profits and move on because the market has been doing what it should not do, which is starting to make new lows. So that's your first important part for having those stop numbers in there. The second reason is it can give you levels to be buying and selling options at to protect your portfolio. So as was brought up here by Patrick, if I'm looking at this, if I start to get nervous that this market might be rolling over and beginning to head south, and I'm long, let's say I'm long SPY, I might be out here actively selling calls. And I might be selling those calls at 44.80 or some price higher. And why would I do that? Well, if I'm selling calls right now, and let's say, for example, I'm going to take this top line off. Let's say we use this 5% mark, which is going to be 42.50 on the S&P. Oh boy, now we started a whole thing, eh? I'll be the Canadian show today. I'll just be like talking like this here and maybe say a couple of times. I've watched Fargo. I know how it is, eh? Of course, Fargo's not even in Canada. It's in, I think it's in North Dakota. All right, no more impersonation. So let's say we're in a situation like this, and my belief, and again, I want to paraphrase this. I'm being hypothetical here, but let's say I feel like this market's going to be selling off more, and my stop loss is down here 5% lower at 42.50. If this was for me, I could be doing a couple things right now. If I thought it was going to keep going lower, just exit your position, take your cash, and reevaluate, maybe go short. Or I could be selling covered calls on this one, and I would be selling them somewhere higher where I don't even think it's going to go. So if it doesn't get up to this price, I keep my shares and I keep all the premium. So it's a nice way for me to make a little bit of extra yield on this position in case it keeps dropping down to 42.50. If it does get to 42.50, then you or below, you close it out. But selling covered calls to me would be an easy way for you to add a little extra yield onto a falling position if you were still going to hold your position until it dropped below a specific level. If that makes sense, everybody? Does that make sense? Right? I'm looking at potentially getting out of this position. And again, we're using the S&P, could be any security, but maybe I'm a little bit nervous that it's getting weaker, but I don't want to sell quite yet. I'm going to wait for it to get below my stop loss. Therefore, start selling some covered calls, generate some yield. Hell, do it on a weekly, right? You might not make a ton of money, but anytime you can increase your rate of return by, let's say, 1% a month, that's great, especially if this thing drops another 3% and gets down to the stop level at 42.50. Now, the other thing that you can do, so as far as preparing, and again, these are specific actionable steps. We'll talk about more theoretical macro market pieces here in a second and how different market segments benefit, or maybe even using shorting, just flat out shorting the markets, or using inverse ETFs. So in this situation, the other piece that you could be doing, is, which I have been doing myself, is when we get an extended move and things really get strong and move up, I end up buying very deep out of the money puts. And the reason I do this is I'm protecting against the black swan event, which I think is coming. I think you're going to see at some point. It's not like we have a 1% down day like today. It's like, oh shit, it was down 5 points today, or we lock limited down on the S&P something. I think those days, they're not done. They're going to happen again because so much money is long in this market. Just like if everything is short, if everybody's short, it doesn't take a lot of buying pressure to force those short bearers into covering their short positions, and that adds more buying pressure and things spike up. It's called a short squeeze. But sometimes I feel like there's even a long squeeze, where right now we're in one of the most bullish phases we've ever seen. More money is pouring into it, and people are leveraging against that money. So they're kind of laddering, if you will, or pyramiding into bigger positions. So it's not going to take a big, sharp slide to, not much of one, to trigger margin calls and liquidations of people's portfolio the more they keep snowballing into these positions to the upside. So the black swan event, while a lot of people think, oh, that's not going to happen, we have systems in place, it's not going to happen, I think it can. I think it can definitely happen, and it probably will happen, and that will be the beginning of the big move down, will be some black swan event I don't know when it's going to come. Nobody knows. That's why they call them black swans. But to prepare for that, same thing I did back in 2020, which I was extremely fortunate with, is I bought puts that were very, very far out of the money. And I would do those for 90 days, maybe 120 days, depending on the option. But what I'm looking for there is I might buy an option that, right now, I don't have my option chain up, but let's say I could be paying to buy them at the money for a 120-day option. Maybe I'm going to spend $30. Well, I'm going to buy way out of the money. Instead of buying the, let's go to SPY here just so I can look at the SPY chart, since that makes it better for me because I buy the options on SPY. If we're looking at the SPY, instead of buying the 439 put option, I might buy something like this. I'm going to scroll way out here. I might buy, let's say, the 380. And you're going, Merlin, there's no way this market is going to get down to 380. It's at 439 on the S&P. There's no way SPY is getting to 380. I'm not counting that it gets all the way down to 380. What I'm counting on is that in the next 120 days, we're going to see a sharp sell-off and breach some of these lows, and all of a sudden it triggers a quick, sharp move. When that happens, that 380 call option, which I probably spent a buck or so on, is now going to be worth $5 or $10, depending on how quickly this thing's moved. So to me, that's one of the ways I use options. Again, that's very high risk, and the risk here is the premium that I pay most likely is going to expire worthless unless I get the black swan. So I look at it as almost an insurance policy for myself. And I know some people out here are using leaps and going that longer term, right? A couple years out with regards to S&P. That's not bad either, but again, the more time you're buying and more time you're getting on your option, the greater that premium is going to be. As an options buyer, I want that long time duration, but I'm also going to pay a lot more for that. Well, there you go. Let's see. I'm not a cat. Is this it? I'm in cash. Hope this is it. Well, part of me hopes this is it too. I'm just tired of seeing this thing just keep going and going and going and going and going. But I don't know if this is it. Judging by the trend, I would say it's not it. This most recent pullback really isn't anything noteworthy in my opinion at all. It's just kind of a blip on the radar. Let's see. Was that an Australian or Gaelic? Now, Mike, if you want to talk like Australian here, I got to spin it up a little bit different here. These wankers out here in the show. Yeah, it's funny. I lived in Australia for a couple of months, and that was a tough one. It's funny. I thought I spoke fluent English, and I went down to Australia, and I'm like, I don't understand what you guys are saying. Same thing in the UK, but you get used to it after a while. Cultural appropriation. You mean my belittling of my neighbors to the north? Oh, it's fun having accents. I will stay away from my Middle Eastern accents. That always pisses people off. We won't even go down that road. All right, so main three things here with regards to preparing for a crash. Always have stop losses in place for every position that you own, long or short. If you are in a position where you feel like, well, I don't want to get out of these positions, but I just don't see it making new highs right now, then start selling some covered calls against your positions, generate some premium that way. If you get taken out, you get taken out. So what? At least you made some premium. Now, if it does end up falling and it gets below your strike price or your stop loss, obviously you're going to have to close out those options and then close out your position. The other thing you can do, especially when things get to all-time highs, because options are usually cheap as they're making new highs, is buy puts, right? Puts become really cheap when things are trending up strong. When they fall like it has over the past couple of days, the premium for puts has gone up sharply in the past couple of days. Now, again, it's only a 2% down move, no big deal. But if it starts to fall a little bit faster and we get to 4, 5, 10%, those put premiums are going to get very high because any seller wants top dollar to sell you those options. Let's see. Brendan, that's a topic for another show. That's a very in-depth one. Everyone's looking at Ethereum right now as being Web 3.0, and I think it could be. I hope so, because it's my second largest holding in my portfolio. So I might even add a little bit more to it here on this little pullback we got here. You're an instructor in Scotland. Oh, yeah, I love it. I love it up in Scotland. That was some of the nicest people on earth. It's funny. I know I digress and always go into random stories. But when I was younger, my car was in the shop, and I was going to work, and I had like a suit on, right? I had a suit tie on. And I had a ponytail, right? But I'm a clean-cut, skinny guy. I'm no threat to anybody. And I hitchhiked for an hour to go get on the freeway and go down like 4 stops to pick up my car. Nobody picked me up, and I was there an hour. In Scotland, I staggered out of a distillery going tasting of the Tomatin distillery in I think it was just south of Edinburgh. Maybe it's Inverness, I forget. And I literally put my thumb out in the first car. Not only did this guy pick me up, he was the most delightful guy. He drove me all the way to my hostel, dropped me off at my hostel. I was like, these people are so nice in Scotland. Not like Northern California where you think if you're a hitchhiker, you're a terrorist and you're going to kill somebody. But yes, loved it up in Scotland. What else? See. Walter says, I don't know, everyone is expecting a crash right now, which makes me think it won't crash right now. Exactly. Which is why you don't, I think when you make that transition, or you're thinking about making that transition from, hey, bullish markets, let's get short, to full-on shorting it, I think you're going to hesitate a little bit. Like, pause, and don't get overzealous and think this is the move, it's going to rip down. It's about reevaluating. So once you go to cash, or if you go to cash in the situation, you reevaluate and say, okay, now that I'm in cash and no longer participating in the up move or down move, what do I want to do here? What are the best segments we look at from a shorting perspective or going long perspective? So let's see. All right. So now to go to Landis's comments, which were this. He says, how do you prepare for market crash? So those are the three things I would suggest just to start with, is have a stop loss in place. If you're long position, sell some covered calls, and then maybe buy some puts outright if you felt like it. Now, Erie says, are you planning to keep 50% in cash? I don't personally think that that's a great idea. I always like to be putting my capital to use. So, there's different ways we can put our capital to use. You could go into something that's not going to be earning you that much. Personally, I'm not a big fan of putting it in things like CDs. I don't think that 1 or 2% is going to make that big of a difference. Maybe there are some bond funds which might get you a little bit better yield. If not, then cash would be the way to go. The problem with cash is you'll always kick yourself if it does what you were in. For example, if you were long and you exited your long position because you thought market's going to crash and we make a new all-time high, then you're all upset because here you are missing out on that move. It's the nature of it. So I'm generally not a big fan of cash unless I'm in the crypto world, because in the crypto world I can go into cash and I can be getting 10% rates of return just by keeping my money in stable coins. To me, that is the better way to keep my cash, as opposed to just keeping it in your TradeStation or Fidelity account making nothing on it. Landis also says, have X percentage of your portfolio in gold. Yeah, most people will tell you 10% should be an allocation into gold. Some might think that's too heavy, some might think that's too little. I think as markets start to crash, if and when they crash, not if, but when they start to crash, maybe you can appropriate a little more allocation into gold in that portfolio, because I think gold will probably do rather well. Now, keep in mind, when we look at market crashes, it's that rising tide principle, right? And normally if market's moving up, just about everything's moving up with it, unless it's an inverse correlation. That said, if the markets start to tank, it's all really going to tank, which is why I hate sector rotation models. Sector rotation models tell you that, when it's in a bullish phase, financials, those start to signal the bottom. And then, when markets start to sell off, utilities do really, really well. No, they don't. Utilities just don't sell off as much when markets crash because we need utilities. They're still going down. So I'm not a big supporter of sector rotation models and saying, well, this one doesn't lose as much when the markets sell off. I think that's hogwash. I would be looking at, as far as preparing for it, I would put some of my money in digital assets, meaning Bitcoin, because I do think that the non-inflation aspect of Bitcoin and the global adoption will keep that one moving up. Maybe have one or two other ones, but I would predominantly keep it in Bitcoin if I think the markets are crashing. The other side for your gold argument is I would probably have some in gold and silver personally, because I like to spread that risk between the two of them. But that's historically been your inflation hedge and done well when markets are not doing rather well. Now you had a question here about putting a certain percentage into real estate. I personally, and this is just my 2 cents, I would say absolutely not. I would rather have capital in hand to buy assets when the markets drop to my desired entry points, or flat short the markets. Remember, we are in an equity market bubble, we are in a bond market bubble, we are in a housing market bubble. And when one of those pops, the odds are really good, it's going to bring down the other ones. So for example, if all of a sudden the housing starts to slow down, and we've seen some of the numbers show a little bit of slowdown here in the last month's reading, if that starts to slow down, a lot of people may try to pull money out of the house one last time, or maybe they started to pull money out of the house. That might have increased their mortgage payments because they took a loan out to take advantage of cheap capital. If prices start to fall, economy usually slows down. Economy slows down, a lot of times people start to lose jobs, or we go into a COVID pandemic lockdown again and more people lose jobs, they go into unemployment, and all of a sudden now we are in a situation where people are going into foreclosure, the housing bubble pops, and then the equity market will come crashing down because people will be selling their investments to pay for their day-to-day living expenses. It's just a perfect storm to help push all these things up right now. At some point, I think it's a perfect storm of everything getting pushed back down. So to me, it's not the place to put your assets in real estate. I know a lot of realtors in the audience and go, wait a minute, long-term real estate's an amazing asset class. It absolutely is, but not after it's moved up, well over 150% pretty much across the country in the last few years. I think it's gone a little bit parabolic. Don't put it there. So where do you put your money? Normally, I would agree with Brennan who says cash is trash. I think by keeping your money in the US dollar, especially the way that it's been printed, is a horrible choice. However, if things really start to tank, wow, NJ and Lori, thank you so much. I really appreciate your contributions today. Thank you. You can park your cash at the TraderMerlin in my website. Thank you guys so much. I appreciate that. I would say normally cash is trash, but maybe what we can do, we'll see time permitting, I've been so damn busy lately, is build a defensive portfolio. Now, my defensive portfolio, and I'm very aggressive when it comes to equity markets and trading. I think you guys all know that. I'm generally pretty aggressive. I wouldn't be going into something like cash. If I thought the markets are going down, I'm going to buy inverse ETFs. Now, I probably will start with 1-to-1s until levels have been met and broken to the downside, creating more opportunity. So, for example, if we look at this chart set up here on the S&P 500, let's go back to S&P futures. We've got these levels drawn, and let's say that 42.50 is that point. I say I'm getting out of my long positions, right? Just hypothetically. Well, I will close out all my long positions, and I'm in cash. If I see it drift lower below 42.50, I might start to buy something like SH, which is single inverse, meaning if the markets drop 1%, I make 1%. If they rally 1%, I lose 1%. So they're inverse, and SH is just a 1-to-1. There's obviously doubles and triples, which I think can get very dangerous. So I might buy SH, and as this continues to drop, I may step it up and start to buy doubles or maybe even triples. If we get below this 20% mark, or this is the 10% line here, yes, that's the 10% line, then I might be even using heavier leverage instruments. Might be going to the futures and shorting S&P futures, but I will start to build a bigger position, and kind of snowball into it, therefore capitalizing on a bigger move. The key for me is, as this thing rolls over, we have to understand that markets over time go up, period. So when they do start to sell off, normally those sell-offs are pretty aggressive and they're pretty quick, and then all of a sudden we get that slow build back up that we see historically. So I can't hold on to that belief system this market's going to keep on crashing and crashing and crashing, but I want to have points where I'm also targeting, saying, hey, if it drops this level, I might scale out of this a little bit, right? So it's just the same thing as going long, where we have our entry, our stop loss, and maybe multiple price targets. If I'm short, I've got my entry, my stop loss, and multiple price targets. So depending on the speed and momentum of a sell-off, if and when it comes, I might be piling into a much bigger position, but I'm going to start off slow simply because at this 42.50 mark, I'm not quite sure if this is the big reversal that everyone is expecting. It could happen. All right, let me see. I didn't fill my water cup, so I got a little bit of dry mouth going on here. Do you distinguish between physical gold and silver or GLD and SLV? Obviously, there's a huge distinction between those two. I would prefer, it's funny, I actually just went to my P.O. box and was just checking my gold holdings, my physical gold holdings yesterday. Yes, there is a big distinction between those two. However, the stability of GLD and SLV, I think you're safe there using those as hedges because of their liquidity and how entrenched they are in the marketplace. It's not like they're an ETF that's going to disappear with your holdings. I personally would much rather have physical gold or silver. The challenge is you have holding costs and you also have massive spreads when you go to buy or sell these things. So the liquidity side of physical is a bit more of a challenge. If all of a sudden the world goes to hell in a handbasket, are my gold coins going to be accepted as barter and exchange? Yeah, possibly. Using my shares of GLD and SLV might not, but I don't think we'll get that bad of a situation where all of a sudden technology has shunned us or we get an EMP on the world and all records are lost. Physical gold wins in that case. Let's see. Jerry says Bitcoin is limited supply, dollars circulating around the toilet. Yeah, and it's just more and more being printed every single day. It's just jaw-dropping how much is being printed. Yeah. I actually was going to start the show off with a fairly solemn note. I don't know if you guys saw this. Did you guys? I'm hoping you did and didn't. It really was a disturbing video, but I think you guys saw the Air Force plane leaving Afghanistan with the thousands of refugees underneath the plane trying to get on, and a lot of people were climbing on this airplane. And in the video, you can see 3 people fall from the airplane because they were holding onto the wheels, the landing gear, just trying to get out of the country. And it's like, man, sometimes we bitch and complain about our country and the way we have it and how bad our government and our policies are. These people were willing to get onto a freaking airplane at all costs and risk pretty certain death to get out of that country. It's pretty sad and depressing at times. I mean, it makes me happy about what we have and what we can do, what we can say, our differences of opinions. But boy, I really feel bad for those people in Afghanistan right now. And it's not just Afghanistan, it's other people around the world who are just totally oppressed. But that was a pretty sad picture holding on to that one. Anyway, sorry, didn't mean depressing. Just stuck in my head. It's one of those things you just go, man, we have it pretty good, even though we complain a lot about what we have. Let's see. Hello, Thomasina. Good to have you. Oh, Patrick. Yeah, it's a tough one. I think you type in, go to YouTube and like a man falls from airplane. It's pretty sad. I mean, you can see like 10 people just grabbing onto the landing gears, and actually like the landing gears going up. I guess when the plane landed, they found some people in the landing gear of it. It's just pretty bad. Anyway, let's go Dixie. Yes, we'll talk about the Dixie, but let me go on, continue on here because I want to. My thoughts are rather scattered today with regards to this topic, which was, how do we prepare for a market crash? If you really think that things are going to have a black swan event, we did the show in February of 2020. I actually had Steve Moses on the program. We talked about how to prepare for a black swan event, and he goes, buy deep, deep, deep out of the money options. And it's funny because after that show, I went and bought a ton of deep, deep, deep out of the money options. And of course, I think it was like 2 days later, all of a sudden it was like, COVID started to become an issue, and then we had the massive lockdown, and that was one of the best paying options trades I've ever had in my life. Anyway, that might be one way to capitalize on this. For preparing, stop losses, sell covered calls on open positions, but make sure you know what you're doing because I see a lot of people selling covered calls the wrong way, and then maybe buy some puts to prepare for it. Once we're in that situation, I don't think there's anything really to talk about other than you have to flip your mindset to I'm shorting any rallies, right? I'm going with the trend. If we find we're in fact in a bear market making new lows and it's trending that way, then don't try to pick the bottom. Just go with that trend until it proves you wrong. Like right now, I mean, this trend to the upside is nothing but up. It proved me wrong back in March, April of 2020. Been long pretty much ever since. I've made a couple little all-time high short trades. They've all been stopped out for losses, but those were very small losses because they were deep, deep out of the money. All right. Yeah, it's pretty horrible stuff. Now, as far as, I know the questions comes up, what about just putting your whole portfolio in crypto? I don't think you do that either. That's too, unless your name is Brendan, you don't put your whole portfolio in crypto because to me that's just way too risky. But I do think allocations into it will do well, and here's why. If we have an equity market crash, there's already tons of money in the equity markets. I think that there's more money pouring into these projects, specifically a lot of the decentralized finance projects within cryptocurrencies and digital assets, because there's so much upside potential for a whole new, a regime change, if you will, in the way that businesses work, meaning centralized entities versus decentralized entities. And to me, I think that is the piece that will keep that whole segment moving to the upside. Just outright opportunity in that sector for those companies. So I think even if markets implode, you'll see DeFi actually do rather well. Again, I think you really have to be careful which ones you're picking. There's a lot of crap ones out there, but I think DeFi is the way to go. And I certainly will keep a large portion, a good portion of my portfolio in the DeFi crypto space. The other stuff I will either be shorting or going into cash waiting for buying opportunities. Now, as this market falls, then it becomes a question of, well, where do you buy back in, right? If we look at this S&P, I'll go and draw in a 20% mark. So the 20% mark is actually what got me kicked off CNBC. You guys all know that story by now. Basically what I did is I went to the high of the S&P 500, which was 1576 at the time. I did a math calculation and said, what's 20% off of 1576? And that ended up being 1260. So on the show, I basically said, if we get below 1260, break out the bulldozers, we're going down in a big way. Well, why 1260? Again, it's 20%. And once we get to 20%, which is right here on the S&P, roughly, I don't have the snap modes, 3585 on the S&P would be 20%. When we get down to this lower blue line here, I'm going to put this in big red numbers because I might as well just keep it on my chart. Let's see, text, I'm going to add this one. Show text, we'll call 20% pullback. Make that bold. I want some nice red letters on this one. Of course, I'm colorblind, so I can't even tell what's red, but that should do. All right, so there is my 20% pullback mark. And the reason this is so important is as soon as we get to, let's say, a 20% pullback, the media will all of a sudden be all over this and be talking about how we're in a bear market and breaking into a bear market. So anything below 20%, that could just act as a massive catalyst to the south side. And I know it sounds crazy, but if we get to 3880 or 3585 and start closing below that, expect to see institutional selling come in aggressively. Why? Because the 20% mark, a lot of people perceive that as that's where it's going to hold. That's the line. You shall not pass, right? If it gets below that, I think in no time you'll find yourself at 3250. I mean, that's a 330-point drop. And then do we start to close any of this gap, which brings us all the way back to these 2020 lows? Sure. Yeah, it could definitely come back down there. Nothing like that. Nothing to worry about. Anyway, wanted to just bring that up because to me, this is the line when I really started becoming an aggressive shorter. And a lot of you would think, Merlin, you left a lot of money on the table. No, not really. I mean, I did, but I capitalized on it once we broke down below 20%, and I started shorting with triple leverage inverse ETFs. SDS and QID were my two main holdings back in 2008, riding that sell-off. Now, I didn't ride it all the way down to 666. I wish. But I had some very nice gains during that sell-off. And, how many people here, not to sound condescending, but how many of you can say that you had one of your best trading years ever in 2008? I can raise my hand because I had planned for it. It hit my numbers. It did what I thought it was going to do. I could have made a lot more if I just held on, but I got a little bit gun shy and pulled money out. I mean, not too many people thought the market's going to drop 50%, but they did. Anyway, let's see. Alan says, you are looking mostly at daily and weekly closes since stocks don't usually bounce perfectly off of certain levels rather than, yeah. I'm using zone-ish. For me, the 20% is an absolute number, right? Because there is no zone for 20%. It's a definitive number where you say, here's the all-time high of the S&P, which if we look at the S&P futures, that's an easy one to figure out. Actually, let's go to SPX. That's a better representation because that's the cash index. So the all-time high for the S&P as we stand right now is 4480. All right, well, that makes it pretty simple, doesn't it? I could just take over my calculator here, and I go 4480 times, I want to go 0.8, right? Because that would be a 20% slide. So 3584 would be my 20% mark. 3584. There you go. So I'll make this line right here, and since it's on SPX, we'll add the text. Actually, sorry, where is the coordinates? There you go, 3584. So I'll keep this on the chart. Hopefully we'll be able to reference this one when it finally happens. 3584. There's our blue line. And that is your 20% retracement. And conveniently, look at 20% retracement. It's right into an area of demand as well. So kind of convenient. Lori says 2020 was the best for you. Awesome. That was a good. Hopefully you're capitalizing on that big sell-off, right? That was a nice one. Which should have a bigger move, VIX or puts on the S&P? VIX. VIX is just heavily leveraged, so you get your percentage gainer move will be bigger on the VIX. I mean, VIX moves very aggressive. Let's see if I have VIX on here. I don't think. Ooh, I do. If you look at VIX, there's your VIX. These moves are aggressive. I mean, just today alone, it moved 20%. And if we get a market crash, you can see what's, this is the beauty. The trend is your friend, right? Well, VIX operates slightly differently, and you can see here that the VIX is still fairly low. It's at 2157 today. Not bad. If you were to get this VIX back up to, let's say, 40, To me, a VIX of 40 means that the S&P is probably going to drop 10%. That's probably a good 10% drop. Brandon, will the crash start in bonds? God, I don't know, man. I know I've got three different things. I know I've got three separate things here. I've got equities, bonds, and housing. I think where you're going to see it start, I think the weakness will show up first, and this is my just personal take. I think the weakness is going to show up first in housing. And I saw a comment, I think it was from Tom earlier, was talking about this rent moratorium garbage for landlords. I mean, yes, it's great to help people out, but boy, if you're a landlord, I mean, what are you supposed to do? You're not making any money, and your landlord, your tenants don't have to pay rent. I mean, that just sounds crazy to me. So I think you'll start to see it round off the housing market first, meaning our pending and existing home sales will start to slide, new home sales as well. Then you'll see mortgage delinquencies start to move up a little bit. I'm not saying spike, just move up a little bit. And then you'll start to see the equity market slow down. From that point, I think then bonds and everything will come crashing down with it. Patty's going to do rather than 19. I paid off a little line of credit and put the remaining balance. Did you get a, Brendan, did you get a zero balance transfer card? Because you get that zero balance transfer card, you can get away from 12%. But you saved yourself 7% right there on that move, so congrats. That's good. All right. Let's see what I got. Landlords. Yeah, right? I mean, I'm lucky I got out of the landlord business. I just didn't like being a landlord. Tenants are just a pain in the butt sometimes. All right, let me see. What do we got? So that's pretty much the discussion for today. Let's see. You guys are still talking about VIX. Nobody likes shorting the VIX. No, but you can go long the VIX. I mean, if this market crashes, buying the VIX is the way to go. Right? Remember, VIX, for those who don't know, is simply the ratio of call options to put options on the S&P 500. And when we get a big spike, that means a lot more people are buying puts, which is protection for a market crash. And, when VIX is high, that's usually a sign that the markets have been crashing. Well, as you can see, this is no big deal. Although today was an interesting spike up, a 20% increase in one day. But if you were to go long on VIX and we saw a 10% drop in the S&P, even if you had leverage with the futures or maybe even with options, depending on which options you were in, you'll probably get an equal or greater rate of return on VIX because it's so responsive. Oh, they don't exist in Canada. Oh, bummer. Sorry. Perfect. Cool. Well, Landis, thanks for that question. How do you prepare for it? For me, in that market situation, go to cash is okay. But if you go to cash, you should have a plan in place as to what you're going to do. Are you going to capitalize on a downside move in the markets by buying the VIX or buying some put options or selling some calls or going short the indexes, buying some, selling some futures contracts and going short that way? There's different degrees of risk, and since most people have been taught to buy and hold, they're not taught to make money when things go down. If we look at the course of financial investments over, let's say 50 years, if you were to buy and hold 50 years ago, you're going to make money. Period. I mean, it's almost improbable for you to even lose money if you held an investment for 50. If you bought SPY for 50 years, you're going to make money over 50 years. What I don't like is we get these massive fluctuations, these huge swings, and I'll bring up, let's say, the S&P here on a weekly. Actually, let's do monthly just to show you the big picture. This is the part that bugs me. These two drops back here, right? You can see this one right here was a 50% drop from 2000 to 2002. It took 13 years for your portfolio or your investment to get back to break even. That's 13 years from 2000 to 2013. But if you're more active and you have rules in place that say, I've got stop losses that will take me out, you might not have caught this whole 50% down move, but maybe you made 30% or half of that. Let's call it 25% in that 3-year window where the S&P was sliding. Most people lost 50% and you made 25. Awesome, right? That's great. Well, it did the same thing, a 56% slide from 2007 to 2009. Again, I want to be able to capitalize on downside moves in the market. So shorting, inverse ETFs, buying puts, using futures markets. I mean, all of those things to me are part of my strategy for when that crash comes. I'm using those because if it does fall, I want to be making some money in that situation and not get left on the sidelines going, I'm all cash. You could simply go into cash. I would probably put it into stable coins, sit in cash and make my 10% as the markets fall. But I'd rather be active and get a greater rate of return on my capital when these markets slide. If the market drops below the trend line on the ES for March 2020 across the last two bottoms in after hours, would you think it's time to start shorting the market? So let's go to the ES, and I will walk you through that visual there. It's a tough one. That trend line is such an aggressive trend line. So we can put a trend line on here, and I think you're talking about this one down here. So it's really a question of where do you draw your trend lines, right? I don't usually like using tails. To me, this is a way too extreme trend line. Even if I spread this chart out, it's way too extreme. I personally like doing it more like this. And that's where my trend line would be, because I like the bodies. Actually, I would probably do it from here. I like the bodies as opposed to the tails. And that's some, I know a lot of people go, what the hell, that's not right. That's the way I do it. That's okay. SH is the one-to-one inverse, so it still has a time decay factor, Medic. Yes, SH, because it's inverse, there is a time decay piece, and it does break down over time. So that's where I would look at it. If we broke that trend line, I'm not so concerned with that one, so it's actually a really good question that you bring up there, Mike. I'm not so concerned if it breaks the trend line to start going short. I think that a break of the trend line is one of those things where you go, oh, I'm on heightened alert, right? It's kind of like saying you hear your car alarm go off, right? Do you run out with your 45 and just start shooting? No. You're like, my car alarm's going off. I better go check it out. To me, it's about going to check it out. And like we talked about with Scott McCormick on Monday, you can have a situation where this unbelievable trend line breaks. But what happens if all of a sudden that trend line turns from that to this angle? It's still up. It's still moving, right? It's still got a nice trend going. So I don't think that just because a trend line is broken that you just start shorting the heck out of it. I would wait for a break below a identified demand zone that I felt was significant. And once that happens, then I'll start building. I'm not going all in right away. I don't believe in Warren Buffett's thing. If you think company's good, you should buy the whole company, not just one share. I think, at least for me, I'm wrong a lot. I'm okay with that. And if I'm wrong, loading the boat going short like I was back last year, that's going to be a costly mistake. So normally, you take last year's outlier out because that was just a very ballsy, aggressive move on my part. Normally, I'm going to start off a little bit slower and start to build into a position. Once I have confidence the market's doing what I think it's going to do, which in this case would be going southbound, I'll start shorting more, shorting more, shorting more, till ultimately I'm in a very sizable position. At all times, though, my stop loss is getting lower and lower and lower, trailing that position south. All right, that's going to do it for today. I actually real quick want to go through some economic stuff. I didn't take a chance to get any images for you. The interesting parts that I saw for today really were crude oil inventories. We had a massive drawdown in crude inventories, which is interesting because crude oil fell significantly today, which did not expect that to happen, but it's headed right towards some nice levels we talked about on the show. Coming up a little bit here, if you're trading the Aussie dollar, you do have some economic announcements. Their unemployment data is coming out, and I'll show you AUD USD. They've been really on an aggressive slide here. That's your monthly, but look at the daily. Today was down again. In a new session, it's actually just bouncing right now, but we've had a 3-day slide that's been pretty aggressive for the Aussie dollar. That's coming off that real sideways consolidation and then breaking down. As far as economic announcements for tomorrow, there are a couple of things to pay attention to. You might want to pay attention to, but ADP non-farm employment change comes out for Canada. For the U.S., they have Philly Fed Manufacturing Index, unemployment claims, mortgage delinquencies, and natural gas storage. And as you guys have seen, natural gas, let's go to NG. Natural gas has also been suffering a little bit. Why am I not finding, there is my natural gas. We've had, a week and a half of nice slide, which is great because natural gas has had just an unbelievable run. The question now, because of it closed where it did, that brings up the question, do we see it drop to 366, which to me is the next logical target. If this doesn't hold right now at 382, I think you're going to see more south side move in natural gas. And that has nothing to do with the inventories or anything like that. I'm just purely going off the price charts there. What else do I have? I think we talk about earnings calendar for tomorrow, right? Earnings calendar for tomorrow. There's always some good stuff happening. We had some nice earnings today. Excuse me. You had NVIDIA report earnings. They were up 2.4%. NVIDIA beat earnings. Target beat earnings. Lowe's beat earnings. It was pretty much beats across the board. Even TJ Maxx beat earnings, and they were up about 5% today. Now, tomorrow, Thursday's earnings bring you a couple big names as well. In the semiconductor and chip space, you got one of the bellwethers, Applied Materials, reporting earnings. And given the way that the retail sales numbers came out on Tuesday, kind of interesting. I see Ross Stores, I see Kohl's reporting tomorrow as well as Estee Lauder. So there are some more retailers reporting tomorrow with regards to earnings announcements. But I really thought they'd be getting beaten up given what was going on with those retail sales numbers. But actually, it tends to seem like it's doing okay. All right, is that it for me, or is it something about marriage? If you like the milk by the cow, good one, Medic, good one. All right, guys, that's going to do it for me for today. We had a long show today, given our short one yesterday. Tomorrow, tomorrow's Thursday? Yeah, no clue what we'll talk about on Thursday. But, Landis, thank you for the prepping for a market correction. At all times, it should be about having a plan in place. I always make the comment about police officers, and they have a job that I would never want to do because it seems like everyone's always trying to shoot at a cop. When they poke their head in the rooms and they're chasing the bad guy, they always got the gun out right and they look around the corner. What are they doing? They're doing two things at once. Number one, they're looking to see where the bad guy is. But number two, they're doing a quick scan of that room and saying, where's my way out? If I walk in this room and all hell breaks loose, where's my exits? Where can I hide behind? What's my defense? What's my plan? For us as traders, it should be no different, right? Police officers risk physical death. We risk financial death if we're on the wrong side and we don't have a plan. A lot of times markets will crash and people just hold on, go, no, it's going to come back. I'll buy more. And it keeps dropping. Pretty soon, boom, your account is destroyed. So have a plan in place. Make sure you have one for bullish markets, bearish markets, and even sideways markets, because that bearish market piece, I guess it's probably next year. I know a couple others think it's 2023. I think you're going to see it next year will be a bigger down move in the equity markets. But hey, I've been wrong before. That's just my target. Anyway, thank you guys so much. If you have questions, feel free to send them on in at TraderMerlin@gmail.com. If you're new, I don't see any real new names out there, but if you are new, hit that subscribe button. That always helps me out. If you like the show, hit the little thumbs up as well. Until then, I will see you guys on tomorrow's show. Take care, everybody.